Money Matters, Episode 2, Industry Regulation. Welcome back to Money Matters, the podcast where we break down the world of wealth and investment management one chapter at a time. I'm your host, and this is Episode 2, covering Chapter 2 of the International Certificate in Wealth and Investment Management, Industry Regulation.
Last time, we explored the financial services sector, its structure, its key players, and the technology reshaping it all. Today, we're going in a different direction. We're asking, how do you keep a global financial system honest? How do you prevent crime, protect investors, and make sure the people handling your money actually act with integrity? The answers lie in regulation, law, and ethics. And that's exactly what this chapter is all about. There are three big themes: financial services regulation, financial crime, and ethical standards. Let's dive in.
Section 1, the purpose and benefits of regulation. Let's start with the obvious question. Why do we need regulation at all? Financial markets are essential to economic growth. They fuel investment, create wealth, and connect savers to borrowers across the globe. But for all of that to work, people need to trust the system. And trust, once broken, is incredibly hard to rebuild. Think about what happens when trust collapses. Investors pull their money out of markets. Banks stop lending. Businesses can't raise capital. Economic activity freezes. The 2008 global financial crisis showed the world just how catastrophic a loss of confidence in financial systems can be. Regulation exists to prevent that. Its objectives and benefits can be summarized in 5 key goals: increasing confidence and trust in financial markets, establishing an environment that encourages economic growth, reducing the risk of market failures, enhancing consumer protection, and reducing financial crime. Regulation achieves these goals through a combination of law and formal rules, covering things like proper standards of market conduct, managing conflicts of interest, treating customers fairly, and ensuring that advice given to clients is actually suitable for them.
Section 2, models of regulation. Not all regulation looks the same. Historically, financial markets were self-regulated, industries setting their own standards. But over time, 2 main formal models have emerged: rules-based and principles-based. Let's start with rules-based regulation. This approach is highly prescriptive. It tells firms and individuals exactly what they must do, step by step, in very detailed terms. There's no ambiguity. You either comply or you don't. The advantage? Certainty. Everyone knows exactly what's required. The disadvantage? It can be rigid, slow to adapt to new situations, and can lead to what regulators call a tick box mentality, where firms do the minimum required on paper without truly embracing the spirit of the rules. And in fast-moving financial markets, maintaining a comprehensive rulebook is genuinely challenging. Principles-based regulation takes a different approach. Instead of prescribing exactly what to do, it sets out broad principles and expected outcomes, and allows firms to decide how to achieve those outcomes. The idea is that different firms operate differently, and rigid rules can be a poor fit for everyone. Firms have flexibility, but they must be able to justify their approach and show it aligns with the underlying principle.
The challenge here? Ensuring that firms interpret principles consistently. One firm's reasonable approach might be another firm's loophole, and regulators must be confident that firms are genuinely meeting the spirit of the principles, not just paying lip service to them. Then there are self-regulatory organizations, or SROs. These are industry bodies through which firms regulate themselves, often alongside government oversight. A well-known example is FINRA, the Financial Industry Regulatory Authority in the United States. In some countries, including the UK, the functions of SROs are carried out directly by government or government-controlled bodies. As financial markets became more global, pure self-regulation gave way to statutory regulation, enabling international cooperation and the development of common standards across borders.
Section 3, International Regulatory Bodies. Because finance is global, regulation needs to be too. No single country can police international markets alone, so a network of international bodies coordinates standards and cooperation. Let's look at the main ones. First, the Bank for International Settlements, or BIS. Think of this as the central bank for central banks. Based in Switzerland and owned by 60 central banks from around the world, the BIS fosters international monetary and financial cooperation. It doesn't deal with private individuals or companies. Its clients are central banks.
Its most famous contribution? The Basel Accords, a series of internationally agreed standards that set capital adequacy requirements for banks worldwide. In simple terms, how much capital a bank must hold as a buffer against losses. The BIS hosts a series of committees through what's called the Basel process. These include the Basel Committee on Banking Supervision, which develops global bank regulatory standards, the Committee on the Global Financial System, which monitors financial markets, and the Committee on Payments and Market Infrastructures, which oversees the plumbing of the financial system, clearing, settlement, and payment systems. Importantly, the agreements reached through the Basel process are not automatically binding. Each country must adopt and implement them through its own national legislation.
Next, the Financial Stability Board, or FSB. This is an international body with a mandate from governments to monitor the global financial system and recommend actions to address vulnerabilities. Its decisions aren't legally binding either. It operates through what's sometimes called moral suasion, essentially international peer pressure. Countries commit to implementing agreed standards nationally, and their progress is scrutinized. Third, IOSCO, the International Organization of Securities Commissions. Founded in 1983 and supported by the G20, IOSCO has 38 principles of securities regulation, grouped into 10 categories, covering everything from how regulators should behave to how markets, intermediaries, and collective investment schemes should be supervised. IOSCO's principles are built around three core objectives: protecting investors, ensuring that markets are fair, efficient, and transparent, and reducing systemic risk. Like the Basel Accords, IOSCO's principles need to be implemented by individual countries through their own legal frameworks. They don't have direct legal force themselves.
Host. Section 4. National Regulators. International standards are all well and good, but regulation ultimately happens at the national level. Let's take a tour of how different regions have structured their regulatory frameworks. In the United States, financial regulation is spread across multiple bodies, a reflection of the sheer size and complexity of the American financial system. Two of the most important are the Federal Reserve and the Securities and Exchange Commission, or SEC.
The Federal Reserve is the U.S. central bank. It sets monetary policy, supervises banks, and plays a central role in financial stability. Its interest rate decisions ripple across global markets. When the Fed speaks, the whole world listens. The SEC is an independent agency that oversees the securities markets, stock exchanges, brokers and dealers, investment advisors, and mutual funds. It enforces securities law and works to protect investors. FINRA, as we mentioned, is the industry SRO alongside the SEC.
In the European Union, the single market in financial services means a coordinated regulatory structure across member states. 3 European supervisory authorities oversee different sectors. The European Banking Authority, or EBA, focuses on banking. The European Securities and Markets Authority, or ESMA, covers securities and markets, with objectives of investor protection, orderly markets, and financial stability. And the European Insurance and Occupational Pensions Authority, or EIOPA, handles insurance and pensions. National regulators in each EU country implement EU directives into their domestic law.
In China, a Financial Stability and Development Committee was established in 2017 as a super regulator to coordinate overall financial strategy. The People's Bank of China, the PBC, implements monetary and exchange rate policy, while the China Banking Insurance Regulatory Commission supervises banking and insurance activities.
In the Middle East, there's a range of regulatory structures. In Saudi Arabia, the Saudi Central Bank supervises banking and insurance, while the Capital Markets Authority regulates the local capital market. The UAE and Qatar have developed sophisticated financial sectors, particularly through financial free zones like the Dubai International Financial Centre and Abu Dhabi Global Market, whose regulators have drawn on best practices from the EU, UK, and Australia.
In the UK, two main regulators share responsibilities. The Prudential Regulation Authority, the PRA, is part of the Bank of England and is responsible for the financial soundness of banks, insurers, and significant investment firms. The Financial Conduct Authority, the FCA, is responsible for the conduct of all financial firms and the prudential oversight of firms not supervised by the PRA. It focuses on how firms treat customers and whether markets function properly. Across all these jurisdictions, financial institutions must typically obtain a license before operating. Regulators assess whether a firm is well managed, has a viable business model, and has effective risk controls in place, and can refuse authorization or impose conditions if not satisfied.
Now let's shift gears to Section 2 of the chapter, Financial Crime. This is where things get serious. Financial crime covers a broad range of dishonest behaviours aimed at financial gain or legitimising illegally obtained money. The main types include bribery and corruption, fraud, tax evasion, cybercrime, identity theft, money laundering, terrorist financing, market abuse, insider trading, and handling the proceeds of crime.
Let's start with the big one, money laundering. Money laundering is the process of converting dirty money obtained through criminal activity, into clean money that appears legitimate. Why does this matter? Because criminals can't just walk into a bank and deposit the proceeds of drug trafficking without questions being asked. They need to disguise the origin of the funds to freely use and invest them.
Money laundering can take many forms: converting criminally obtained cash, handling stolen goods, facilitating the investment of criminal proceeds, or helping process funds linked to terrorism. There's an important distinction between money laundering and terrorist financing. Terrorist financing can involve small amounts, even legitimate funds, being used to fund terrorist acts. This makes it harder to detect. But both share sophisticated international networks and similar techniques, so many of the same countermeasures apply.
The global response to money laundering is coordinated through the Financial Action Task Force, the FATF, which was established by a G7 summit in 1989. The FATF has set internationally agreed recommendations for anti-money laundering and counter-terrorist financing programs, implemented in over 200 countries and jurisdictions worldwide. The FATF focuses on three things: setting the standards, evaluating how well member countries implement them, and identifying emerging money laundering and terrorist financing methods and trends.
The FATF also maintains a list of non-cooperative countries and territories, countries whose anti-money laundering systems are deemed inadequate. Being on this list is a significant reputational and economic pressure designed to drive improvement.
Other international bodies play important roles too. The United Nations, through its Office on Drugs and Crime, provides technical assistance and enforces conventions requiring countries to criminalize money laundering and terrorist financing. The International Monetary Fund assesses countries' compliance with international AML standards through its Financial Sector Assessment Program. And the World Bank supports developing countries and works through the Stolen Asset Recovery Initiative to help return stolen funds to their country of origin.
Let's look at how money laundering actually works in practice, through its three classic stages: placement, layering, and integration. Placement is the first stage. This is where dirty money enters the financial system, typically by depositing criminal cash into a bank account. In recent years, cryptocurrency has become a new placement vehicle, allowing conversion of physical cash into digital currency. This stage is where criminals are most exposed because large cash deposits attract scrutiny. Layering is the second stage, and for most financial firms, it represents the biggest risk. Once money is in the system, the launderer moves it around repeatedly to obscure its origins, buying and selling foreign currencies, shares or bonds, transferring funds across borders, using complex corporate structures. Each individual transaction is designed to look innocent, like normal investment activity. The purpose is to make it impossible to trace the money back to its criminal source.
Integration is the third and final stage. The money has been successfully cleaned, and the launderer can now invest or spend it without obvious risk of incrimination. The money might be withdrawn in cash, invested in property, or channeled into legitimate business ventures. At this point, the illegal origin of the funds is effectively invisible. Anti-money laundering provisions are designed to catch criminals at the placement and layering stages, before integration makes the money truly untraceable.
Financial firms have specific obligations when it comes to anti-money laundering. There are 5 main offences to be aware of: concealing, disguising, or hiding criminal property; arrangements, facilitating someone else's acquisition or use of criminal funds; acquisition, actually acquiring, using, or possessing criminal property; failure to disclose, not reporting a suspicion of money laundering when you should have; and tipping off, alerting a suspect that a disclosure has been made about them.
The obligations placed on firms cover 3 main areas. First, carrying out customer identification procedures and keeping records. Second, training staff to recognize suspicious transactions. And third, establishing robust internal controls, including appointing a money laundering reporting officer, or MLRO, whose job is to receive reports of suspicious activity, assess whether they indicate genuine money laundering or terrorist financing, and file suspicious activity reports with the relevant law enforcement agency. Failure to comply can result in unlimited fines, jail terms, and loss of license. The consequences are serious, and deliberately so.
This brings us to client identification, an area that every person working in financial services needs to understand thoroughly. Regulations require firms to carry out customer due diligence, known as CDD, for all new clients. This means identifying who the client is, verifying their identity, understanding the beneficial owner where relevant, and establishing the purpose and nature of the business relationship. Firms must also check where the client's funds are coming from, not just who they are.
For individuals, acceptable identity documents typically include a passport or international driving license for proof of name, and a utility bill for proof of address. Only originals are accepted, not copies.
For corporate clients, proof of identity comes from constitutional documents, like articles of association, plus accounts and, for smaller companies, details of key individuals like directors and shareholders.
One particularly important concept is the politically exposed person, or PEP. This is someone who holds or has held a prominent public function: government officials, senior executives of state corporations, politicians, senior party officials, and their close families and associates. PEPs require heightened scrutiny, enhanced due diligence, because of the elevated risk of corruption and bribery.
Enhanced due diligence also applies when clients aren't physically present during identity verification, when they're based in high-risk countries, or when transactions are complex or unusually large. On the flip side, simplified due diligence can apply to lower-risk clients, like banks, publicly listed companies, or public bodies, where the risks of money laundering are deemed lower.
Next, let's talk about insider dealing, one of the most well-known financial crimes. Insider dealing, also called insider trading, occurs when someone with information that isn't available to the general public buys or sells securities to profit from that information advantage. For example, imagine a company director who knows, before any public announcement, that their company's profits are going to massively beat expectations. If that director buys shares in their own company before the announcement, they're committing insider dealing.
The key concept here is unpublished price-sensitive information. Information that is specific and precise, hasn't been made public, and if it were made public, would significantly affect the price of the securities. When a company publishes this kind of information through an official channel, like the London Stock Exchange's regulatory news service in the UK, it becomes public and trading on it is no longer insider dealing. The securities covered by insider dealing rules are broad: shares, bonds, warrants, depository receipts, options, futures, and contracts for difference. Notably, commodities and their derivatives are typically not covered.
Who qualifies as an insider? Anyone who received the price-sensitive information from an inside source, whether they're a director, employee, or shareholder of the company, someone who accessed it through their professional role, or someone who obtained it directly or indirectly from such a person. In nearly all markets worldwide, insider dealing is a criminal offence punishable by fines and imprisonment.
Related to insider dealing, but broader, is the concept of market abuse. Market abuse is the umbrella term for behaviours that distort financial markets or give certain participants an unfair advantage over others. Regulators group several types of behaviour under this heading.
Insider dealing, as we've already discussed, is one, but there's also improper disclosure, where an insider leaks price-sensitive information to someone else. Misuse of information, trading on information that isn't public, even if the person didn't get it from a traditional inside source. Manipulating transactions, trading in a way that creates a false impression of the supply or demand for a security, artificially pushing its price up or down. Manipulating devices, using fictitious transactions or deception to distort prices. Dissemination, spreading false or misleading information about an investment. And distortion, creating misleading impressions about a market more broadly. Market abuse is typically treated as a civil offence. Insider dealing can be treated as civil or criminal depending on severity. IOSCO explicitly recognises both as threats to the integrity and stability of financial markets, and while enforcement efforts have improved, these practices continue to evolve alongside new technologies and communication channels.
Now let's move to the final section of Chapter 2, and in some ways the most important one: ethical standards.
Regulation and law set the floor. Ethics sets the ceiling.
Following the global financial crisis of 2007 and 2008, and a series of mis-selling scandals in multiple countries, trust in the financial sector took a severe hit. Commission bias in the UK, fiduciary standard debates in the US, and the revelations from Australia's Royal Commission into misconduct in the banking, superannuation, and financial services industry all exposed deep cultural problems in how parts of the industry treated clients.
Restoring trust requires more than just rules. It requires financial professionals to internalize ethical values and act with genuine integrity, not just legal compliance. Ethical codes of conduct provide the framework for this. They articulate the principles and values that professionals should embody: honesty, fairness, transparency, and accountability. They're designed for people who want to do the right thing for the right reasons.
A useful self-check when facing any ethically ambiguous decision is to ask 4 simple questions. Is it honest? Have I been truthful with everyone involved? Is it open? Is everyone affected aware of the consequences? Is it transparent? Have I been clear and not misleading? And is it fair? Have I ensured no party is unknowingly disadvantaged or unfairly advantaged?
Another commonly quoted test: would you be comfortable if your name appeared in the media in connection with this decision? Would you be happy for your friends and family to know what you'd done?
The Chartered Institute for Securities and Investment, the CISI, has its own code of conduct, built on 8 principles that define the ethical duties its members owe to their various stakeholders.
The first principle is personal accountability, striving to uphold the highest personal and professional standards, acting with integrity, honesty, skill, care, and diligence, and avoiding actions that damage your organization or the profession.
The second is client focus, putting clients' interests first, treating them fairly, acting as a good steward of their interests, never seeking personal advantage from confidential client information, and using client data only for defined purposes.
The third is conflict of interest, being alert to and actively managing conflicts of interest, complying with regulations, being open and cooperative with regulators, and challenging and reporting unlawful or unethical behavior.
The fourth is respect for market participants, treating counterparties and business partners with respect, observing proper standards of market integrity, good practice, conduct, and confidentiality.
The fifth is professional development, committing to continuing professional development and supporting the development of others.
The sixth is aware of capabilities, declining to act on matters for which you're not competent or qualified unless you have access to appropriate support.
The seventh is respect others and the environment, treating everyone fairly, embracing diversity and inclusion, and considering the environmental impact of your work.
And the eighth is speak up and listen up, actively encouraging a culture where people feel safe to raise concerns and recognizing your responsibilities to the communities in which you operate. These principles don't just apply to what you do, they shape how you do it and why.
Let's do a quick summary of everything we've covered today. Chapter 2 of the International Certificate in Wealth and Investment Management is all about the rules of the game: formal, legal, and moral.
Regulation exists to build trust, protect consumers, support economic development, and reduce financial crime. It comes in 2 main flavors: rules-based, detailed and prescriptive, and principles-based, focused on outcomes and behaviours. Self-regulatory organisations play a role alongside statutory regulation in many markets.
International bodies, the BIS, the FSB, and IOSCO, set global standards, though national legislatures must implement them. National regulators, from the Fed and SEC in the US to the FCA and PRA in the UK to ESMA in Europe, translate these standards into enforceable domestic law.
Financial crime, especially money laundering, is a major concern, addressed through international coordination via the FATF and through firm-level obligations including customer due diligence, suspicious activity reporting, and staff training. Money laundering operates in 3 stages: placement, layering, and integration. And anti-money laundering controls aim to catch criminals before integration is complete.
Insider dealing and market abuse, including manipulation of prices and dissemination of misleading information, undermine market integrity and are treated as serious offences globally. And finally, ethics. Regulation sets the minimum standard, but the financial services industry needs professionals who go beyond compliance, who ask not just, is this legal, but is this right? The CISI's 8 principles provide a clear and practical framework for ethical conduct.
That's it for episode 2 of Money Matters. Whether you're studying for your CISI certificate or simply deepening your understanding of how financial markets are governed, I hope this chapter gave you both the technical knowledge and a sense of why all of this matters. Not just for passing an exam, but for building a career in finance that you can be genuinely proud of. Next episode, we move on to Chapter 3, Asset Classes and Financial Markets. We'll explore the building blocks of investment portfolios, cash, bonds, equities, property, and the markets where they're bought and sold.
Until then, stay curious, stay ethical, and I'll see you next time.